A recent Vanguard study shows that 75% of investors have money in something called a target date fund. Now, if you're not sure what a target date fund is, the premise is pretty simple. There is a given year attached to these funds, whether that's 2025, 2030, 2035, and you generally set this year, or you pick your target date fund in the year you are going to retire. So let's say you're planning on retiring in 2025, you would pick a 2025 target date fund. And as you reach that 2025 year, it is slowly going to move more money into safer assets in order to have a balance of growth as well as safety, trying to target a given portfolio entering into retirement. Well, in this video today, we're going to talk about 4 reasons that you should avoid target date funds, why the promise of target date funds is actually quite off target for your retirement. So let's jump into it. Now, the promise around target date funds is really simplicity. There are thousands of different investment options that you have to try to build your optimal retirement portfolio. Now, in comes the target date fund. A target date fund is one simple fund that is going to rebalance and adjust your portfolio in a way to target what is supposed to be an optimal portfolio by the time that you retire. Now, because of this simple promise, many investors have flocked into these funds, and these funds have grown in size. Over 51% of 401k participants are invested in target date funds. So what's wrong with these target date funds? Why shouldn't you own target date funds for your retirement? Well, first off, they're a one-size-fits-all type of planning. And rarely have I ever met a client that needs a one-size-fits-all type of solution. And so with each target date fund, what you'll notice is there's really 3 core assets that they're investing in within that target date fund. They're investing in stocks, bonds, and cash. Now, this in and of itself leaves behind a universe of options for you to invest in. But the bigger issue is how these allocations and these changing allocations over time fit your retirement picture. So again, a target date fund has a given target, whether that's 2035, 2045, at some kind of year. Further away you are from that given target year, they're going to have you invested in primarily stocks. And over time, they're going to follow a glide path type of investment structure where they slowly wean you off of stocks and put you into safer assets like bonds and cash. Now, the problem around this is it thinks that every investor is the same type of investor. They have the same income needs. They have the same type of situation. They have the same assets that they ultimately want to invest in. And on the screen right now, we have an income graph that shows someone's situation moving through time. And this is a very common income graph that we often see. So this person is retiring well before they're on Social Security, and so they're delaying Social Security. They're going to have a point where they have an income gap. We see this over here during these portfolio withdrawals, where they have a significant amount that they are taking from their given portfolio. But once they're on Social Security, we see that they're taking far less from their situation. Well, a target date fund would basically not look at this situation at all. They would slowly move this person from a larger stock allocation to more of safer assets, bonds and cash, as this person ages. But again, we see this as actually the exact opposite of what this person would actually want. For instance, for the first couple of years of their retirement, they have a much more safety focus. Again, they're taking large amounts from their assets. But once they're on Social Security, we see that they have a far smaller income need moving through time. And so this person has the potential to have more of a growth focus later in their retirement. And so again, a target date fund would not take any of this into consideration. Reason number 2 why you don't want to own a target date fund is they have captive investment options. Now, if we think back into history, thinking about how the financial planning and investment planning space has evolved through time, previous decades, there were broker dealers. And at the start of broker dealers, these broker dealers were captive. So let's say that you had a broker with Fidelity. Well, that broker would only be able to recommend Fidelity options for your situation. Now, in preceding decades, the whole idea around having an independent advisor or independent investment options came into existence and was a fantastic add-on to your situation, because now you weren't captive to one specific fund family or one specific company. Now you had options around all different funds. Well, essentially, a target date fund is stepping backwards into the past, because with most target date funds, they are captive investment options. So for instance, let's take the Fidelity Freedom 2030 target date fund. They are allocating solely to Fidelity options. We're picking one fund company and basically saying, I only want to own this given fund company's options. 98.6% of target date fund holdings belong to the same fund family. Now, what are the odds that one fund company, whether that's Vanguard, Fidelity, American funds, what is the likelihood that they have all of the best funds in every given sector, in every given sub-asset class, in every given fund category? I think very unlikely, which is why, again, you want independence when choosing your given portfolio. Now, there's a fantastic research paper that I'm going to be referencing quite a few times within this given video. It's called Off Target on the underperformance of target date funds. It was released in 2021, and they basically look at target date funds and why target date funds are often non-optimal for your situation, looking at all the given drags and underperformance that target date funds will provide relative to other options that you have. And on the screen right now, we show the cost of captive investment options. For instance, they compare Fidelity 2030 fund performance relative to a replicated portfolio of ETFs. So this replicated portfolio is foregoing mutual funds, specifically just from Fidelity, and going towards ETFs. And what we see is the replicated portfolio outperforms the target date fund by 11.5% over the sample period. And the correlation between the two funds was almost perfect. It was 0.993. And so we see that this captive investment option has a serious drawback to your given situation. Again, you want independence in terms of designing your given portfolio. Even if you like the one-size-fits-all approach of target date funds, you are better off designing that given portfolio through independent option. The number 3 reason to avoid target date funds is what I think one of the most important reasons to avoid target date funds, and that's poor wealth management strategies. First, we're going to be looking at an income withdrawal example. So let's say that we're in a target date fund and the stock market is up 15% over the last 6 months, and retiree John needs $10,000 from his portfolio. Now, as we think through the given allocations that we hold, again, having a balance between stocks, having a balance between bonds or some other safe asset, having a small amount in cash, I'm not saying that that doesn't make sense in general. Instead, what I'm saying is that a target date fund offers no customization, no planning in terms of choosing your given withdrawal strategy. So for instance, let's say the stock market is up 15% in the last 6 months. This person needs $10,000. Well, if this person sells $10,000 from their target date fund with the target date composition that we see on the right-hand side of the screen here, they're going to be selling $4,000 of U.S. stock allocation, $1,000 of international stock allocation, $4,000 of U.S. bond allocation, $1,500 of international bond allocation, of $500 of cash. And so when they hold this set of allocations, they're going to just across the board be selling out pro rata of each of these given funds, whether that's optimal or non-optimal in this given situation. Let's look at the opposite situation. Let's say the stock market is down 30% in the last 6 months and John needs the same $10,000. Well, guess what? This target date fund, when John sells $10,000 out of this target date fund, they're going to be selling $4,000 of U.S. stock, $4,000 of U.S. bond, $500 of cash, and so on. And so generally when we're holding safety for a very specific reason. Rarely do we want to just specifically pro rata take from each of those given funds. Again, we're generally holding cash, let's say, for short-term income needs, meaning that specifically in a stock market downturn, we might want to take all of our income from that cash allocation. We then might want to take from bond allocations or maybe even rebalance bonds into growth allocations if the market is at a deep enough discount. But a target date fund offers no dynamic adjustments through this given period. When you're selling, let's say, one share, you're selling 5% of cash, whether you want to or not. You're selling 40% of U.S. stock, whether you want to or not, which again, I can promise you is going to be non-optimal as we move through time. There are likely ways that we want to dynamically adjust our allocation, taking income from specific areas. Let's also look at this in terms of adjusting our portfolio allocation. Again, a target date fund assumes that you want to follow this glide path regardless of any other variables within our retirement. And so let's say you're in a position where you are in this transition phase of the target date fund, meaning that this target date fund is slowly going to transition you from riskier assets, stocks and international stocks, into safer assets, bonds and cash. Now, what happens when this transitionary period is happening, let's say at the start of a bear market, let's say 2008, and ending at some place moving forward into the future? Well, essentially what's going to be happening is we just suffered a market downturn when we had the majority of our money in stocks. Then as the downturn happened and stocks are at a huge discount, this target date fund is slowly going to transition assets from our growth portfolio that was just down and is in its recovery to safer assets. So we're essentially locking in a given drawdown. We experienced the drawdown when we had large allocations into stock, and then we're transitioning from stocks to bonds at the time where we might actually want to be adding to stocks rather than transitioning from stocks. And so a target date fund takes no considerations into whether stocks are overvalued, undervalued, or any given changes through time. And this is extremely important, specifically when we're talking about today's market environment. What's been happening to bonds, let's say, over the last 10, 20, 30 years? Well, interest rates have essentially fallen in a way that has been fantastic for bonds. Essentially, bonds have had a 40-year tailwind at their back as interest rates have been falling from the mid-teens down into the 2% range. And now when we think about the outlook for bonds, specifically in this high inflation, low interest rate environment, Bonds may be the last thing that we want to invest in. A target date fund is going to slowly be transitioning you from growth assets to bonds at the time where you likely want less into bonds and likely want to be allocating to other alternatives. And so again, there are no adjustments in target date funds to market environments. They're going to just keep you on this glide path without any consideration of your goals, without any considerations of the investment strategy, off the income strategy, or off the given market environments that we are currently facing. And this leads us to the fourth and final reason why you should not own target date funds for your retirement, and that's higher fees. So on the screen right now, we have more of a general fee analysis. This is from Morningstar. This is looking at their annual fee study. And as we see here from the different asset classes, there is an allocation asset class. Now, it's important to understand that all target date funds are in this allocation class, but not all funds within this allocation class are target date funds, if that makes sense. And so this is a larger look at allocation fees relative to some other fees. We see that we pay a premium for an asset allocation passive fund of 0.44% per year. Now, all an allocation fund is a combination of basically all other funds. It's a fund of funds, if you will. And if we just look at the average fee of individual funds in each of these passive asset classes, we can see that we can combine any number of funds on a pro rata basis and pay significantly less than we would inside an allocation model. But let's go one step further and look specifically at target date funds. We're again looking at the study of off target on the underperformance of target date funds. Now, in this study, the largest source of target date fund underperformance is the fee gap, which averages 4.8 bips per month. In layman's terms, this basically means 0.048% per month or 0.57% per year. Fee gap is remarkably stable, albeit decreasing over time. This is partially because we've seen fees decrease over time. Now, some may look at this fee and think, well, basically 0.5% isn't really that much. That's not really costing my situation that much, is it? Well, this fee drag compounds over time. Again, with everything in our financial situation, it compounds over time. And so let's look at $10,000 invested in a simple 60-40 portfolio since 1971. Now, since 1971, a target date fee drag would have turned $10,000 into $736,482. Well, eliminating this given fee drag, we see that $10,000 now turns into $980,144. So well over a $200,000 gap over time from just $10,000 invested in 1971. And so as an investor, we can see for reasons like one-size-fits-all planning, captive investment options that drag down your performance, poor wealth management strategies, looking at income withdrawals, as well as adjusting to market environments, as well as the high fees that target date funds hold, we see that target date funds are quite off target for your retirement in such a way that we recommend you should not own target date funds and instead build a portfolio that's designed specifically for your situation. If you're interested in exploring other ways to build a better portfolio for your retirement, our team here at Safeguard Wealth Management can help. Hope you enjoyed this video. Hopefully you got a lot of value out of this video for reasons why you should not own target date funds despite so many investors owning target date funds. Always remember that you don't need more money, you need a better plan. If you like this video, please hit the like button down below. It will help other retirees just like yourself find this video, as well as hit the subscribe button. We release videos on a weekly basis. You will be notified of all future videos that we release. Thanks for watching, and thanks for taking some time out of your day to improve your retirement. We look forward to seeing you in the next video.